Hey, this is Trader Travis. Welcome to another video of my 30-day challenge. I have the camera on today. So what I'm going to do today is answer a couple of questions I received from a client I work with, as well as give you another update on my portfolio. The market is now officially in correction territory. It's fell 10%. So out of transparency and to be unlike any other trainer or guru you see online, because they hide their losses for whatever reason, I don't know why. I'm like, just tell the truth, guys. Losing money is a part of all investing. Warren Buffett loses money, right? So what's there to hide? Show people the truth. Show people how to handle the truth. So let me show you my truth. Okay, my truth is, as of now, so the market is officially fell 10%. My portfolio shows a decline, and I'm going to correct myself because well, 2 days ago I said I lost money. I was like, God, that's not true. My account declined, but I did not lose money. Big difference. Losing money is like if I close a position and I lost $19,000. But this decline, I pretty much ignore. It's a paper decline. And the reason why is because I have insurance here. As a matter of fact, I bought more insurance, right? So my initial core insurance was right here. It is up $8,000. It made $4,200 today. So this goes to show the calculation I showed you a couple of videos ago. I said I have a couple of strategies, right? They are insured. Those strategies stop losing money at a certain point. In that video, my put was up $1,700 that day, and I said, hey, if this happened 6 days in a row, you know, what did I say? I said I could make $10,000, $16,000. You're seeing that, right? I'm going to keep making money on my portfolio insurance, but all these other strategies have a cap to them. They stop losing at a certain point. My put does not. And also, I'm renting out my stock shares as usual. That's making me money. So I'm actually, this is bona fide profit I am making, right? I don't give this back. This put is not profit. So I'm going to answer a question that I'm always asked. Travis, are you going to sell it for a profit and book that $8,000? No, right? Why? These puts are not for profit. These puts are for peace of mind. Get that through your head. These are for insurance only. Said another way, I always talk about how if there's going to be a market crash, right now it's not a market crash, it's just a market correction. I always say, hey, if we have a market crash where the market falls 40 to 50%, Travis will not lose 40 to 50% of his account. How do I know that? Because I have insurance. My cap on my portfolios is 10%. That is only how much I am willing to lose. So these puts are for peace of mind, right? If it goes up in value, whatever, I just ignore it because I'm like, no, this is for Armageddon, right? A crash, I'll file an insurance claim, get all my money back. In this case, if I file an insurance claim or sell these puts when I really need them, about $100,000, $165,000 will show up in my account. So I'd more than recoup whatever I lost in the crash. So no, I don't sell these. These are for insurance, right? These are for peace of mind. Now, if I do book this profit, I no longer have peace of mind. If I get rid of this insurance, I now have a traditional buy and hold portfolio like everybody else where you can lose, 50, 60, sometimes 100% of your money. No thanks. Been there, done that. You buy and hold people, you can have that. I am tired of losing that much money. So now I'm like, nope, what I'm mentally comfortable losing in any given year or any given 2 years is 10%. And so I structure my portfolio so that max loss is about 10%. So this decline is more than a 10% decline in my portfolio. But again, it's just a decline. It's just the way the platform works. And I showed this a couple of days ago in the Success Academy live call, right? I said, okay, in this account, if I bought $30,000 worth of stock and the market declined 50%, my platform would show a decline of $15,000. I would ignore that because I would have insurance to insure all 30 grand. So I would file an insurance claim and get my 30,000 back. So the declines I pretty much ignore because I know I have insurance. And when I'm ready to file that insurance claim, I'll get all that money back. So that's how I am okay. And I kind of make jokes about me losing money the last few days. And I'm like, yeah, I'm not technically losing money. It's just a decline. And the reason I'm not going to lose money is because I have insurance. Okay, moving on here. So now what I want to do is answer a couple of questions I received from a client. Would you mind going over how you handle your mindset as far as cover calls, right? They bought the stock at $339, but this time, because the stock market declined, Like, I'm not going to scoff at a couple of bucks, and this is for selling cover calls again. I would make only about $20 or $30 if I go 30 days out. I'm having a hard time choosing when I should place my cover call. I feel like I have head trash. Maybe you could give me advice to help. Absolutely, I can give you advice, because this is a common experience, and it's so funny because I have shares in my non-competition account, the one that you all don't see. I bought shares of SPY at $339 too, the market high, right? And the market as of now is at $297. So let me show you what I actually did in my own account, and then walk you through what I was going through emotionally, because I've had a chance to work through that. All right. So for people who don't know what cover calls are, they're what I call renting out your stock shares. A lot of people, it's the oldest and most widely used option strategy. A lot of people don't know that they can extract instant income from their portfolio. The way cover calls work is you buy 100 or more shares of stock, right? It's in a 100-share block. So let's just use simple math here. So if I bought 100 shares of SPY right now where it's at, I have to cough up almost $30,000, so $29,000 and some change. But then I can come in here and rent out. It's like rent to own. It's literally like a lease purchase contract on a rental property. I can come in here, and where the market is now, I'd probably do about 2 weeks out. I can come in here and say, hey, I'd sell this contract to someone at $298, and pretty much I'm telling them, hey, you can buy my stock from me at $298. Same again, lease purchase. Someone rents out your house. You set up a contract where they can buy. In exchange for that, they pay you rent, or premium for that option. It's called a lease option. That's how this works. I'm going to get paid $743 to give somebody the option to buy my stock. They don't have to buy it. Sometimes they won't buy it. But if they do, I bought it at $297. I sell it at $298. So I make a tiny bit of money, on the sale. But that $743 is mine to keep. And so what people will do when they teach this strategy, you take $743, the premium you receive, and you divide it by how much you bought the stock for, right? So just in 2 weeks' time, I can make a 2.5% return on my money just in 2 weeks. Instant guaranteed cash. This is a guaranteed thing. When you click the buttons, the money immediately shows up in your account. It's yours to keep, right? And if I did it twice a month, that's about 5% I can make on my account. So somebody teaching the strategy, that's what they will show you. But anybody who's actually implemented this strategy over a given time knows that the reason you're getting $7 now is because the market crashed. Something called volatility increases the option prices. They're usually not this high. It's usually about $2 or $3, right? And then you run into an issue. What if you bought the stock at $339 like I did? The market is now down 10% below where you bought it from. That little $700 you received on the front end is not making you sleep well at night. Is not compensating for all the money you lost during the decline. And not only that, now you're like, wow, now when I try to do cover calls, I don't get as much money. And that's what this member is saying to me. If they come out per our rules, we sell cover calls at or above our purchase price. Not cost basis, but purchase price. And that's for various reasons, which I won't get into in this video. And so you can see here now, they come out, well, they said 30 days out. So let's go 30 days out and show which one they were looking at. So she was right. She get, $11 share. She sold a 30-day cover call. This is where she says she was struggling with and maybe head trash and walk through the mindset. Well, the good thing is she's no longer a profit snob. That's what I call a profit snob. Anybody who turns up at easy money, they're what I call a profit snob. And I will repeat what a millionaire told me rather recently, right? When somebody was like scoffing at receiving $11 selling a cover call. He was like, oh, you're so rich now you can turn away money? And I was like, ooh, burn, right? And he quickly chastised him. He was like, you don't get rich turning away money. And I was like, I had never looked at it like that before. Previously, I looked at the $11 and was like, that's not even worth my time, right? I was like, I want at least $200 or $300. But when I really meditated on what he said, you don't get rich turning away money, right? I was like, that is so true. $11 here, $20 there. It all adds up. So anything that can increase my wealth and I'm going to do it. This is passive income. I do nothing. So what Travis actually did in his own account, because again, I bought shares at 339 just like you did. I came out about 50 to 100 days. And so you can spread it out. You can do, depending on how many shares you have, you can do some at 50 days here, right? And the 50-day ones, you get $20, right? Well, I got 100 and something. I did mine a couple of days ago. But you could do some right here at 50 days. You get $23 right now. So some you do at 50, and then you can come out to 78 days or 113 days. And the reason you come out a little bit further is just because you get a little bit more money. So you kind of split it up a little bit. And you click this right there, and you can see something's wrong. Oh, because of the price, let's just come up to 340 after hours. So you get about 85. So you can you get a little bit more money here, right? Problem is you're only going to get about $300. If you have to keep doing this all year long, you're only going to get about $300. I won't say only, but a lot of people are profit snobs. They'll scoff at this and be like, oh, it's only $300. I'm like, okay, $300 divided by 29,000. I invested, what is that? 1%. Now let's look over here at Yahoo Finance. What is the dividend currently on SPY? 1.75%. So those little $20 covered calls you're having trouble selling equal a 1% dividend. It's an extra dividend. You doubled your dividend. You doubled your dividend when the market was crashing. That is what I call the double your dividend strategy. So yes, that's my mindset. I take the 20 bucks. I'm like, hey, if I can double my dividend clicking a few buttons and doing no extra work on my part, I take it. Again, you do not get rich turning away money. Next question this person asks is, hey, do you ever break your rules a little bit? No. I'll stop you there. No. Right? Do you ever break your rules a little bit when the market falls? Well, first of all, why are the rules in place? So Travis won't go bankrupt again. So no, I don't break my rules, right? I broke my rules before. It never ends up good, right? You're like, no, been there, done that. No, thank you. The rules are in place to protect me from myself. So I'll show you an example of that before I let you go, because once again, these videos are getting long. All right. So do you ever break your rules when the market falls and you want to buy more calls? Maybe it's greed, but I feel the itch to buy one or two more call options. I feel comfortable with the loss if the market doesn't recover. Are my thoughts crazy? No, your thoughts are not crazy here. The best time, honestly, to buy stocks is right now. The best time, in my opinion, I'm not giving investment advice, but best time to buy some call options, at least some long-term call options, are right now. The market is in a decline. You get them pretty cheap when the market recovers, or if the market recovers, you'll make a lot of money. But the issue is, what if the market doesn't recover? So here's the rule I have for when Travis has that itch to be greedy. Because remember, the rules are there to protect me from myself. What I didn't point out, I might have pointed out earlier, I bought more insurance here, $285. So the last few videos, that wasn't here. Only my core insurance of 5 contract was there. I bought more insurance. Why is that? Because Travis had the itch to be greedy. And one of my rules now is like, okay, Travis, if you want to be greedy, earn the right to be greedy. So I bought more insurance, but I also bought more calls. I bought 4 call options here. So yes, I bought calls just like you are itching to do. I went ahead and bought it. But per my rule, I'm like, Travis, don't throw a bunch of money at the market just because you're trying to get greedy and make a whole lot. Always have prudence, have some kind of built-in prudence in your investing system. So my prudence is, if I want to be risky, I have to earn the right to be risky. And so I had to cough up, $3,000, $4,000, maybe $5,000 more to buy some insurance. And then I have earned the right to, added a little bit more call option risk. So that is how I handled it. And that, my friend, is the end of today's video. I hope it added some value. For those who are not, fully familiar with options, you might have been lost a little bit, but that's okay. This video will stay on the web. Just come back to it when you have a little bit more experience. But for more experienced members, I hope you got a peek into this twisted brain right here. You take care, and I'll see you on tomorrow's video. Bye-bye.